Hello and good evening, everyone. Today we have Miss Anuja Pethia. The pleasure of welcoming an accomplished legal professional to our live class. Miss Anuja began her journey in the legal field with a BA LLB honors from the National Law Institute, University, Bhopal, graduating in 2013. She then pursued an LLM in International Crime and Justice from the United Nations Interregional Crime and Justice Research Institute in Turin, Italy. After returning to India, she cleared All India Civil Services examination in 2015 and joined the Government of India as an assistant director. In this role, she was part of the Indian Corporate Law Service under the Ministry of Corporate Affairs, working in the office of the Regional Director, North Zone in New Delhi. Here, she gained valuable experience over a rewarding 2-year tenure. Since December 2018, she has been actively practicing law and managing her own law firm, Swarnim Partners and Associates. She is also an advocate on record at the Supreme Court of India. Her career has seen a transition from law school to civil service to legal practice, where she has developed a strong foundation in various aspects of law with a focus on litigation and dispute resolution. Today, she will be leading our session on insolvency law, specifically discussing the interplay between the insolvency and bankruptcy code and tax laws. We are excited to have her with us today. Welcome, ma'am, and over to you for
Thank you so much for
the
that very
class.
introduction. So we'll start off with the topic, and I'm assuming that you guys have attended some sessions on. Let's start with the session, and today we have a session on the interplay between insolvency and tax. So all of you must be aware that tax laws are framed. Tax laws, the purpose of tax laws is to get revenue for the government. No government can function without revenue or without money. And in order to get money, you have to tax people, right? So I am trying to see, because a tax and insolvency can be very boring, can be a very boring topic. So I'll just try to keep it as simple as possible, so that you guys, the motive is that at the end of the session, you know something about how tax law and IBC work together. So why is the relationship between tax law and IBC very important? The reason is that taxation or the amount of revenue that the government gets depends on the number of taxable entities that are there, right? So the more, for example, if there's a population of 100 people who are earning and who are in the tax slab, then 100 people will pay tax. But if there are only 20 people, then the revenue of the government will automatically reduce. So that is why insolvency is very, very important, because once a company goes insolvent or bankrupt, it dies. And the revenue stream of the government also comes to an end. So insolvency, in a way, promotes revenue growth of the government by providing for an effective resolution of sick entities, which is very important for the economy of our country to grow. Now, IBC, the purpose of IBC, I'm sure you must have studied that there was the Insolvency Act prior to that. Then there was official liquidators. There were presidential insolvency acts, which never worked properly, and companies were never able to revive. There was the twin balance sheet issue. I'm not going into all of that because I'm assuming that you have studied all of that. So the purpose of IBC was to provide a speedy mechanism to overhaul the corporate distress resolution regime. Now, tax laws are also, by their very nature, they're a process of recovery. So you can here again see the similarity or the alignment of goals between the two statutes. IBC also, in a way, is there to maximize the assets of the company and to keep the company going. Tax laws are also based on recovery. So cash flow is very important for both IBC and for tax. Now, Section 238 of IBC is something you people must have studied by now. So 238 essentially says that IBC will override any other statute that is in conflict with IBC, right? So how do we then reconcile both these acts when the statute, the IBC itself provides that it will override the tax law, when largely or somewhat you can see that their purposes are the same. So initiation of CIRP, the first question that anybody who wants to understand the interplay between tax and IBC would want to know is that can the government or can the tax authority initiate CIRP? And the answer is yes. So under Section 9, tax authorities can also initiate CIRP proceedings provided that they meet all the other eligibility criteria under the statute. Now, the next question that anybody would ask is, what is the effect of moratorium? Section 14 provides for the moratorium. So what is the purpose of moratorium on, what is the effect of moratorium on the tax authority? So what is the purpose of moratorium? You know that the purpose of moratorium is that the assets of the corporate debtor should be protected. They should not be, taken away or, uh, uh, washed away during the CIRP process. They should be in the control of the RP or liquidator. So that once the company is taken over, the SRA has the benefit of those assets, right? So moratorium says that fresh proceedings which are pending or fresh proceedings cannot be initiated, and any pending proceedings, they are essentially stayed. Now, assessment under tax, we all know that assessment is the process through which a demand is created. So under taxation, anybody who files their income tax return, if the income tax authority finds that that return is not according to law, or if there is suppression of income, or there is income that has escaped assessment, that process is called assessment. There are various types of assessments that are done under the Income Tax Act. And once that assessment is over, the assessing officer then raises a demand against the company or the taxable entity. So assessment is the process through which a demand is created. And as of now, as on date, the law that holds water says that assessment is not a proceeding under which is impacted by moratorium. So while moratorium is imposed, an assessing officer can can do assessment of the company, and any details that have to be provided, or any legal proceedings, etc., that have to be done regarding the corporate debtor has to be done by the resolution professional. So moratorium has no impact on assessment proceedings that may be taken on by the income tax authority. Now let's look at what is the role of the RP during the CIRP process with respect to tax authorities. So these are some basic sections regarding duties of the RP, which are also applicable to any assessment proceedings which might be started by the income tax authority. So section 17, subclause 2, subclause D, it says that RP has authority to access books of accounts, and this includes documents of CD which are available with the government authority. Right. So this means that if there are any ITR, etc., which RP is unable to access, he can request for a copy of the same from the income tax authority. Section 18, subclause F, subclause 2, and 25 2A says that it is the RP which takes control and custody of any asset of the corporate debtor which over which the corporate debtor has ownership rights, including even though the corporate debtor is not in possession of the same. Right. So next is section 17, subclause 2, subclause E, which says that the RP is responsible for complying with the requirements under any law for the time being enforced during CIRP. So whenever a company is functioning, so the idea of IBC is that the company never dies. Even when the RP is appointed, it is always a going concern. And what does a going concern means? That its daily activities are going on like a regular, they would have been had the company not been insolvent. So whenever a regular company or any entity is functioning, there are always transactions that happen, which include tax liabilities such as TDS, TCS, filing of returns, etc. And that responsibility lies with the RP. So if the RP does not fulfill his responsibility, it is a breach of his code of conduct, it is a breach of his statutory duty, and it will invite liability on the corporate debtor. So you people have studied Ghanshyam Mishra, I'm assuming, again. So if I'll just recap it. So section 31 of the code provides that any approved resolution plan is binding on all stakeholders. And all stakeholders over here include creditors, which includes government, right? So the intent of section 31 was to protect, is to ensure that all stakeholders abide by the approved plan, and that there is no liability which comes onto the SRA. And the leading case law on this is Ghanshyam Mishra, which set the law down, which said that government dues also qualify as an operational debt, and they are extinguished if they do not form a part of the approved resolution plan. So in effect, what this means is that if the income tax authority has any dues against a company which has gone into CIRP, they are also supposed to file their claim form as an OC or secured creditor, whatever they fall under, right? So they also need to file their claim form, and if they have not filed the claim form, then their dues will get extinguished because of Section 31 and because of Ghanshyam Mishra. So this principle has also been recognized in SR Steel. Now here is where it starts getting a little bit more confusing. So Rainbow Papers was a landmark judgment that was given by Supreme Court, which muddied the waters a lot when it came to debts of government. Why? Because in Rainbow Papers, what had happened was that the Gujarat VAT authority had imposed tax on a corporate debtor, which underwent CIRP. And Section 48 of the GVAT Act specifically said that if any person has not paid its dues, then the first charge on the property will be of the Gujarat VAT authority. And the RP in this case had treated the Gujarat VAT, claims of the Gujarat VAT authority as not secured. And this was overturned by Supreme Court. So Supreme Court said, I'll just read the concerned part. Supreme Court said that it is the duty of the RP to examine the books of accounts of the corporate debtor, which would have reflected the liability arising due to statutory demands. Accordingly, Supreme Court held that such a resolution plan cannot be considered binding on the government. So if you see, the problem here is that this ratio of the Supreme Court went against what was the principle laid down in Ghanshyam Mishra. So on Ghanshyam Mishra, on one hand, the Supreme Court had said that once a resolution plan is approved, it doesn't matter if your claim was not treated in a particular manner, it stands extinguished. In Rainbow, what happened was that the Supreme Court said that it doesn't matter if your claim was not treated in the correct way. It was the duty of the RP to classify it as in the right category. So this was the difference in the two judgments. Rainbow created a lot of confusion because a lot of government authorities, not just income tax authority, but a lot of government authorities started coming forward to say that they are secured creditor. After Rainbow, there was a change in law again because of Pashchimanchal, which we will discuss in the subsequent slides. So the question is that does Rainbow paper apply to income tax matters? So all of you again know that Section 238 provides that IBC would override the provisions of any other law that is inconsistent with the provisions of IBC. And this has been upheld by Supreme Court in the Sandesh Bhatt judgment, where it had held that whenever there's a conflict between two laws, IBC would override the other law. And because of Section 38, the Income Tax Act was also amended. Now, this is important that because of Section 38, 238, the Income Tax Act was amended to ensure a harmonious interpretation between the two statutes. So Section 178, subclause 6 was amended with effect from 2016, which is when the IBC also came, to provide that Section 178, dealing with a company in liquidation, would override the provisions of any other laws except IBC. So over here, what has happened is the Income Tax Act now includes a specific provision which says that Income Tax Act would override all other laws except one law, which is IBC. So IBC, whenever there's a conflict between Income Tax Act and between IBC overrides Income Tax Act. That is settled. So this was different from GVAT. Why? Because under GVAT Act there was no such provision. Plus GVAT Act also created a secured interest of the authority in the property of the defaulter. So now developments that have followed Rainbow Papers. So like I said, Rainbow Papers caused a lot of confusion because it classified government debt as a secured creditor. And a lot of government authorities started coming forward and saying to say that we are also secured creditor and you cannot treat us as OC. So Supreme Court came out with this landmark judgment again, Pashchimanchal, where it said something very telling. It said that Rainbow Papers did not take into account the waterfall mechanism. So they said that while we are a coordinate bench, we cannot override or comment on what was decided in Rainbow. But they said that Rainbow Papers was constricted to the specific set of facts in that particular case only, and it did not lay down a general position of law. So this again sort of realigned law with what was laid down in Ghanshyam Mishra. So now I want to speak about Section 148 notices. Right. So Section 148 is the assessment proceeding. So I had spoken that assessments are carried out by the income tax authority. So again, what is an assessment? Assessment is when any entity, for example, if I, let's say, file an income tax return for 10 lakhs per annum, the income tax authority will scrutinize my return. So there are various types of assessment which are done. And upon scrutiny, let's say there is a scrutiny assessment done of my income tax return. And if the income tax authority in the assessment finds there is some income which is escaping assessment, then they can issue a notice to me asking me to reply to them to explain why this income should not be added back to my return and why I should not be penalized for hiding a part of my income. So this procedure is undertaken under Section 148. So Section 148 gives authority to the assessing officer to send notices to a taxpayer. This implies is that the AO, assessing officer, has some suspicion that income has not been disclosed properly. So income tax officer issues a Section 148 notice to reassess the taxpayer's income tax return. The various high courts, what in context of IBC, this has been a very, very litigated part of IBC and tax law. And high courts have said that once a resolution plan is approved, all dues, including statutory dues, stand extinguished, and proceedings in respect of such dues cannot be continued. So, Section 148 pertains to assessment of escaped income, and it cannot be used for purposes beyond its scope, such as collecting evidence against third parties. So, one of the landmark judgments in this is Alok Industries, and I'll just give you a second to read it. So the ratio in Alok Industries was that while income tax authority can take legal action against previous management, they cannot do so under Section 148 of the Income Tax Act. So Tata Steel Limited is another landmark judgment which has come out last year, where the Delhi High Court has said that the principle of a clean slate, the clean slate theory that we studied in Section 31, and we also saw in Ghanshyam Mishra, is applicable for successful applicants under IBC, wherein dues for periods prior to the approval of the resolution plan cannot be recovered. So, if there are any dues of the Income Tax Act which are prior to the CIRP process, they cannot be recovered from the new management. So, here you can see the entire process being divided into three parts. One is pre-appointment of IRP and RP. So, any claims of the Income Tax Department that are prior to it have to be filed as a claim with the RP. Otherwise, they stand extinguished. Second phase is the CIRP period. During that, we have seen that moratorium does not apply to a corporate debtor, and it is the resolution professional who has the duty to file the returns of the company and also to file or pay any liabilities that the corporate debtor incurs during his being appointed as the RP. And the third phase is when the plan is approved and an order is passed by the adjudicating authority saying that this plan has been approved on so and so terms. So once the plan is approved, any pre-CIRP debts for that, SRA is not liable unless something is provided for in the plan. Whatever is provided in the plan, he will be bound by it towards the income tax authority. So these are the three phases, and this is how dues are to be paid to the income tax authority. So Tata Steel, you have read. There's another important judgment, Murli Industries Limited of the Bombay High Court, where again the High Court said that any claims not raised during the CIRP process and not part of the plan cannot be pursued subsequently. So now the issue that is being faced is that income tax authority, see, a lot of times, most of the times actually, as a counsel for the department, I can tell you that forms are not filed by the income tax department because AOs come to know about this quite late after the cutoff line has passed. So they don't file claim forms, and there are huge income tax liabilities that are to be paid by the corporate debtor, which are not paid eventually because the claim is extinguished. So now there are conversations going on about introducing amendments to the IBC or Income Tax Act, wherein some liability can be affixed on the directors, erstwhile directors of the company. Right now, there's no liability on the erstwhile management of the company or erstwhile directors of the company unless there is some personal guarantee which was there because of which a tax liability arose. So, if the income tax department does not file its claim, then there is no remedy that it has left to pursue. Now, this was income tax. I want to discuss a few other things with you, which are not part of the slides, but there are some specific amendments which have been made to the Income Tax Act. And if somebody is really interested in reading how Income Tax Act evolved after after IBC, you can just take note of these sections. So Section 140 of the Income Tax Act is one section which has been amended after the IBC came into play. So 140 is something very basic. It says that in case of a company, the return is to be filed by the managing director. And if the managing director is not available for any reason, then it will be filed by the director. So we have read section 17(1)(b) in the initial parts of the slide, where we said that the powers of the board of company are suspended on the appointment of an IRP. So the question is, who will file the income tax return? And the answer is it will be filed by the IRP or RP. So the Income Tax Act was amended. Section 140 was amended to include that whenever a company is undergoing a CIRP process, the return has to be verified by the insolvency professional appointed by the adjudicating authority. So Section 140 is one section which has undergone a change. Second section that was subsequently amended was Section 79 of the Income Tax Act. Section 79 of the Income Tax Act provides that carry forward and set off of losses in a closely held company are allowed only if there's a continuity in the beneficial ownership of the shares. So set off and carry forward losses is a concept in Income Tax Act, where if ownership is transferred to another beneficial owner of the shares who has more than 51% voting rights, then you can carry forward and set off losses. So the question is again that if CIRP happens and SRA is appointed, the SRA is not a beneficial owner who's related to the previous owner. So Income Tax Act was again amended to facilitate carry forward and set off losses for companies which were acquired by SRAs. So that's the second change which happened under the Income Tax Act. Third is minimum alternate tax. So you people must be aware that MAT was introduced sometime back as in before the present government with the BJP government, MAT was introduced on the book profits of a company. So Section 115JB was introduced in the Income Tax Act. And what Section 115JB says is that MAT will be applied on book profits of a company. So it is a deduction in respect of the amount of loss brought forward or unabsorbed depreciation, whichever is less as per the books of accounts. So in 2018, there was another clause inserted in this, which says that these book profits will aggregate amount of unabsorbed depreciation and loss brought forward shall be allowed to be reduced from the book profit. So I understand this is a little technical. Income Tax Act is a little technical, but if you can just note down these sections and go through these amendments, it will really help you understand how Income Tax Act is applicable to a company which is undergoing CIRP or has undergone CIRP. So the next section which was amended was section 156. So 156A, capital A, has been added to the Income Tax Act. So we know that Income Tax Department continues to challenge the reduced tax liability after a resolution plan is approved. So the 2022 Finance Act, they inserted section 156 capital A, which says that AO shall modify the demand payable in conformity with the order of the adjudicating authority. So whenever there's an outstanding demand against a corporate debtor, And there's a resolution plan which is submitted, which says that, okay, 100 crores are pending towards income tax department, and the SRA says that I am willing to pay 25% of it or whatever, so and so percentage of it, and this is eventually approved by the adjudicating authority. So section 156 capital A gives powers to the assessing officer to modify the demand notice to bring it in conformity with the NCLT's approved resolution plan. So that was another section which has been changed after IBC. 178 subclause 6 is something I had discussed earlier also. So whenever a company was under liquidation, the liquidator could not distribute any assets of the company without taking an NOC from the income tax department. The commissioner was authorized to first give an NOC, and once that NOC was obtained from the income tax department saying that, okay, we have no dues against this company, only then could he approve. Only then could the liquidator distribute assets. So this was creating a lot of delays in CIRP, because the liquidators would write to the income tax department and they would receive a delayed response. So there was another amendment which was carried out in the Income Tax Act, which said that as per section 178, subclause 6, provisions of 178 are not applicable to companies which are undergoing liquidation under IBC. So the IBBI also took out a notification saying that a liquidator is authorized to distribute assets of a company without obtaining NOC from the income tax department. Next section that has been changed is section 46 of the Income Tax Act. So section 46 of the Income Tax Act says that any shareholder who on the liquidation of a company receives money or any other asset from the company shall be chargeable to capital gains tax. So another clarification was issued in this regard, saying that where there's a voluntary liquidation or liquidation, residual amounts being received in form of assets shall not require any further valuation. So these are the changes that have been carried. These are some of the major changes which have been carried out after the insolvency code came into existence. And there are still amendments coming every year as we sort of see how these two acts work out together. So yes, Bhumika, that's all I have on this topic. If there are any questions on this, I can take them. So before we end, I would strongly recommend going through these judgments that I've cited in the PPT. I will also circulate the PPT so that you can take your time and read through these judgments. Secondly, there are a lot of amendments which have happened in the Income Tax Act after IBC, and I've highlighted a few of these judgments. I hope you've taken them down. I have highlighted some of these sections, and I hope you've taken them down. And if you are interested in getting more into Income Tax Act, I would suggest that you go through the amendments. There are numerous other amendments which have happened.
Ma'am, just one doubt I had. So the first phase of the CIRP, like the 3 phases that you talked about, in the first phase, it was pre-CIRP, in which the income tax department has to file claims to the RP, right?
So pre-CIRP, there are 2 things that can be happening. One is that the corporate debtor has not become insolvent yet, and the income tax department has raised demands against it. If that is the case, then once the RP is appointed, they are supposed to file a claim against the corporate debtor like any other creditor.
Yes.
And if during the CIRP process, if there are any demands that it's raising, then the RP is supposed to discharge them, or if RP thinks that they are not correct, then RP will take appropriate action, appellate mechanism, or go to a writ or whatever it wants to do. So RP is the person who will challenge those orders by the income tax authority.
So basically, like when the CIRP was initiated, before that, whatever the demand is there from the tax department, then that will probably, because of the claims and all, and obviously they are operational creditors, they will not have that amount of say. And again, after that, priority will also not be there when it comes to the resolution plan. So that would mean that any demand that was raised before the initiation of CIRP, and once they have to obviously fill the right forms for in order to initiate that claim, so that in all probability will not be like the income tax department will not succeed. Whereas on the other hand, if during the CIRP there is a demand that is raised, then that will follow the normal process as if the company is active and alive. And then if during that 1 year, like the CIRP is ongoing, the RP is filing appeal, he loses that appeal hypothetically from the Supreme Court as well. Then
Yeah.
that payment that is due, then the RP
Yes.
will have to make that payment or what?
Yes, RP will have to make that payment. Then that demand crystallizes.
Then the demand crystallizes, right? And after the approval, then there is clean slate. And like after the approval of the resolution plan,
Yeah.
whatever previous claims are there.
Yeah. So after the approval of the resolution plan, if there are any pre-CIRP dues, then it's a clean slate. If there are any dues during the CIRP also which were not raised by the income tax department, then also there will be a clean slate. So during the CIRP, if the income tax department is raising demands, etc., if it is doing something, then it will be liable.
Then the company will be liable, right?
Yes.
Yes,
Yeah.
ma'am. Okay, ma'am. Thank you.
And there's another minor difference in this, that pre-CIRP, what I've spoken about is demand. Sometimes after a demand, what happens is that there are penalty notices and property is also attached by the income tax department. If because of that attachment, the income tax department becomes a secured creditor, then there will be a different course of action. Like it will be a secured creditor then. It won't be an OC.
Okay. Ma'am, I don't remember, but I think I read a case. I think the name was CA Jason Joes or something. I don't remember exactly, but it was against the Enforcement Directorate, in which the High Court held that if the ED has attached some property and then the company undergoes CIRP or liquidation, then till the time the CIRP or liquidation is ongoing, the property will not remain attached. And after that, once the proceeds have come to the resolution professional or the liquidator, as the case may be, then accordingly those proceeds will be distributed to the ED, and then they have all the right to have a lien on that proceeds. But till the time that is happening, I think I don't know whether this will be upheld in the Supreme Court or something, but I think as of now, whatever attachment happens till the time the CIRP or the liquidation is ongoing, I think they say that no, you cannot do the attachment. I'm not sure about it, but
so with respect to ED, the position right now, there is no Supreme Court judgment on
yes,
this now. There's one leading Bombay High Court judgment and one Delhi High Court judgment. So if a company starts going through CIRP and there is a provisional attachment. So under ED, there are two types of attachment. One is a provisional attachment, and once the adjudicating authority under PMLA confirms it, it becomes a permanent attachment.
Yes.
So if there is a provisional attachment by the adjudicating authority under PMLA,
yes, ma'am.
They can carry on with the attachment during the moratorium period. Moratorium will not impact the attachment. But once the plan is approved, then they have to let go of the land, because attachment.
That's section 32A.
Yeah, 32A, absolutely correct. Because attachment does not mean ownership of a property. It simply means that there were some criminal activities which the ED suspects. So you're right.
Yes.
So if there are no more questions, should we end the session?
Ma'am, this presentation will be available on the website, EBC's website.
I'll circulate it to EBC, so you can. I think EBC can circulate it to you, whoever has taken the course.
Yes, ma'am. Thank you so much, ma'am.